Good morning, curious investors. It's another great day to just embrace the opportunities ahead of you. And as you do that, I just encourage you to know that life is risky, know that investing is risky, and know that you have an opportunity to embrace that risk and do the best you can with it. Everything has a risk to it. A risk is an unexpected outcome, and everything has that sort of thing. But before we begin today, let's go through the investment risk for you. How's that sound? Let me get over to the disclaimer page here. And let me share that with you. It's like my first day on the machine here almost. Share screen. All right, here you go. Curious investors, for your safety, these are the disclaimers. If you wish to remain unidentified and not in the recording, please remove your name and your face from the screen view. This is a broadcast that's strictly our opinions. Gimbal Financial stock investing includes risk, including fluctuating prices and loss of principal. If you don't lose principal in investing in stocks, you are not investing in stocks. You're doing something else. Dividend payments are not guaranteed and may be reduced or limited any time by the company. Following information is not a recommendation in relation to any named securities. Any references to specific securities are for illustrative purposes only. Content provided at the event is for general information only and not intended to provide specific advice for any recommendations for any individuals. All indices are unmanaged and may not be invested in directly. Any economic forecast set forth during the event may not develop as predicted, and there can be no guarantee that any strategy will be successful. These thoughts and opinions are those of Gimbal Financial and not those of LPL Financial. Any tax references or illustrations only seek advice from your tax professional before you do anything that requires ideas suggested here. These the securities that we invest in are offered through LPL Financial, a member of FINRA and SIPC. Investment advice offered through Gimbal Financial. We are an registered investment advisor and completely 100% separate from LPL Financial. How's that? Does that sound reasonable to you all? All right, let's get this show going, shall we? I thought today I would spend my time with you and talk about stock investing and what that might look like and how you might go about doing that. And it has been a season for which stock investing has become popular. That doesn't happen all the time. Usually after people get bloody noses in the stock market, the curiosity and interest in it goes away. So that's the way it works. It has kind of ebbs and flows over time. And if you are a stock investor, you're going to know that those times ebb and flow. And usually what you want to do is wait for one of those times for which the general market isn't overly optimistic, and then you can begin to set your sights like a sniper on the investments you'd like to have in your portfolio. So I put together a list of some ideas to help you consider what it is that you want to do when you're investing in stocks, and just some ideas that I learned from my own mistakes over the years. And so hopefully these will be helpful for you today, and hopefully we can offer other advice that would be good to you as well. So I'm going to share this screen. And make it a little bigger here. All right, here we go. Before you can invest in risk in the market, you need to accumulate and define your at-risk money. When I say accumulate, you can today you can invest very little money and begin training in the stock market, but you accumulate what you think is the right amount for you to begin making money in the market, or striving to make money. Let me reword that. And when I say at risk, you have to know when you put this money in the stock market, it will likely go down in value. And so do not set aside any money that you're not willing to see it go down in value. That's the first step. You have to have money that you're willing for it to drop in value. And so Define whatever amount that is, save it up and set it aside, and then you're ready to start the process. Generally speaking, trying to do stock trading on paper does not work as well as putting money at risk, because there's a psychological and an emotional concept that goes with investing that can't be replicated just by doing it on paper, because real money creates different emotions than just doing something on paper. So that's the first thing. And then secondly, know your risk versus your return expectation. Let me share another screen with you here. Well, let's just walk through this one real quick. So what I want to show you now is a little calculation I did called risk versus return. And the risk versus return gives you a picture of, try this again. Here we go. This gives you a picture of what risk and return you're thinking about. And so when I do the risk versus return calculations, I put the question there, how often do you expect to be correct in your stock selection process? First of all, you should never expect to be correct 100% of the time. Maybe you're only going to be right 25%. I don't know what your number is going to be, but I gave you two illustrations here. I gave you a 50% of the time you're going to be right, and a 33% of the time that you're going to be right. And I just was showing you your risk versus your return expectation on this specific example. So let's say that you're going to expect to be right 50% of the time, and you're going to risk 5% of your investment. Okay. So what I'm suggesting to you is you always try to get at least a two times rate of return of what you're risking. What that means is if you risk 5%, then you need to get 2 times that, or 10% rate of return. That's what the 50% batting average. And why that is the case is that if you said I'm going to risk 5% to make 5%, you're going to run out of money if you're only right half the time. This way, it allows you to be wrong once and still have a rate of return if that's what your batting average is. Then I went over here and I said your batting average is only 33%. And so if you're only right 1 out of 3 times, and you're going to risk 5% each time, you have to make at least 3 times that to get a 5% return. So it's 3 times 5% is your expected return of 15%. Did I make this clear as mud? So you're risking at a 50% batting average, you got to do twice the risk to make a return. At a 33% batting average and you're risking 5%, you got to do 3 times the risk to get a 5% return. So that's what the example was here. And then I showed you a $20 stock. What is 5% risk? It's $1. If it's a $50 stock, 5% of 50 is $2.50. That's how much you can let the stock go down in order to keep the math of your risk versus return calculation working for you. Then your expected return on each of those, a $20 stock to get a 10%, is you need the stock to go from 20 to 22 to begin to get your 2 times 1 risk level on that. And for a $50 stock, you need it to go up $5 to 55. If you're only batting a third, then the numbers are going to be a little more challenging. You're going to need to go from $20 to 23. You need a $3 gain on your stock, or from 50 to 57.50. These are just basic math. They don't pertain to any particular stock, but stocks in general. You choose your risk. If you let a stock drop significantly, then you've chosen a great amount of risk, and these numbers are even more difficult to do. Down here, I showed if you're going to allow a stock to drop 10%, that means in the 20 and 30 and the $50 stock price, you've given yourself a $2 downside risk and a $5 upside or a $5 downside risk on the $50 stock. So to get 2 times the risk, you need a 20% return. 2 times 10% is 20%. So you need your stock to go up to $4 or $24 or to $60 on this example to get your 50% batting average to begin to work for you. Again, if you're at a 33%, you need much greater numbers. So your $20 stock's got to go to 26 to offset any of the losses that you take, and your $50 stock's got to go up to 65. That's the risk versus return calculation, and that is that's just some basic math. And if you've got questions on that, feel free to call me at Gimbal Financial, and we can talk through that basic math. But if you want to start investing in stocks, I'd encourage you to look at the math before you start trying to buy stocks, because if you're just randomly buying stocks, you're probably going to just run out of patience, run out of money, and get frustrated and think it doesn't work. All right, so next, let's know your risk versus return possibilities. Let's look at the we just did the math of winning versus losing is what I just did there. Let me show you another example here of some things I did a few weeks ago with y'all. What other math did I have up here? So this screen I showed you a few weeks ago when you joined me, and it just says determining how much to invest. So you decide how much you're going to money you're willing to lose, and calculate the percentage you allow to determine your mistake, and then you just do the basic math. So I did an example here of a $500 loss that you're willing to accept, and if you have a 5% risk that you're given on that, 5% of $500 means you can invest $10,000 and give yourself 5% risk on that. If you're taking a 10% risk, you divide your 500 by 10%, and that means you can only risk $5,000 to give yourself a 10% risk. And if you want to give yourself 15% risk, that's going to give you $3,333 to give you a 5% risk. So when you're talking about investing your resources for the long haul, and you're talking about setting aside money for risk, you need to take into account what that really means and how it will affect you emotionally as you begin to accept risk into your own mindset as you begin to trade in individual stocks. All right, let's go back to our outline here. I would say, once you know your risk return and you know the math of winning and losing, and is to identify a repeatable process that you can do time in and time again. Because if you're just randomly selecting stocks, the stock market will most likely beat you up. I know certain names have been popular in the last 6, 12, 18 months, and they may remain so. But history has shown the best performing stocks, after they peak out, I think 50% of them drop almost 80 to 90%, and something like 65 to 75% of them drop more than 50%. So the risk on the downside, if you're just picking a stock that's been successful, can be substantial to you. So what you begin to do is identify a repeatable process. And so then as you begin to look at companies, you know exactly what you're looking for. And I can give you some books to read on that if you have more curiosity on that, to give me a call on those things. The repeatable process would then include how many stocks you want to own at once. I would suggest that number be fewer than more if you're going to want to own individual stocks. If you're going to want to own a lot of stocks, I'd encourage you just to hire somebody to make those decisions for you, because it's very time consuming to own stocks, and to own, say, 30 stocks, most people aren't going to have enough time to do that, and you should hire somebody professionally to make those sorts of decisions. And then what stocks should you buy? Again, that's going to be part of your repeatable process. You need to identify the sorts of stocks that you think would make the most sense for you to make money. And again, there's a number of good authors that have written some very compelling ideas about that. One of those is William O'Neill, and his book is How to Make Money in Stocks. I saw this week that William O'Neill celebrated his 88th birthday, and he's been an amazing investor over time. So he gives you an idea of what to do. And then when will you sell those stocks? We just went through an example of knowing the winning and losing math. It gives you an example that you would use something called a stop loss to prevent those stocks from dropping below certain preconceived percentages as you're getting into the market. And as you're knowing when to buy and when to sell stocks, you're going to want to have a really good idea what direction the market is going at the time that you're going to put your money at risk. Generally speaking, you do not want to put your money at risk when the market is trending downward. You want to wait for it to reverse that trend and begin its way upward again. And it's going to save your capital. It's going to allow you to minimize your risk on the individual stocks. So there's ways that you can know the general direction. William O'Neill's publication, Investors Business Daily, or IBD, it has a indicator of their opinion on a regular basis, which direction the market's going, and that's a very simple indicator. It's readily available for you at investors.com. I would suggest as you're a relatively new investor that you just mark off any stocks below $10 a share. I can go into a great amount of detail with you individually if you like, but in general, what happens in order to get invested in the market, you want to find stocks that are trading regularly. And when I say trading regularly, there's plenty of investors that are buying and selling stocks in the particular shares in the particular company that you're looking at. A lot of those stocks below $10 don't have a lot of people trading them day in and day out, and consequently that brings risk that is caused by the illiquidity of that stock. And the technical term for a lot of those stocks below $10 is that they have a large spread. And again, we can get into the details on that, but that's the difference between the bid and ask price. And if you have a wide range in those prices, you're putting yourself at more risk than some of the more liquid names that are traded above $10 a share. I think I would throw out there to you is that you can use other people's ideas as research, but not your buy list. Don't buy something just because you see it on a Reddit post or you see it on a TV talk show or you hear it on the radio or a friend is talking at dinner how much money they made in it. That's not a way to buy stocks. The reason it's not a good way is because that's not a repeatable process. Most people that are successful in buying and selling stocks aren't telling you every single transaction they make. And so the ones that are giving those to you away for free are most likely not going to give you the right buy and sell times on those individual stocks. And I've been talking really quickly today, so we will open this up again another time for more questions and answers. But I think the final thing I'd say is that you can avoid, there's enough companies out there to buy their shares in that you can avoid buying any stocks that are trading below their 200-day moving average. And there's a number of publications out there where you can find what the 200-day moving average price is of a stock. And if it's trading below that 200-day moving average, it simply suggests to you that that stock is trending downward, and there's no reason to buy a downward trending stock when there's plenty of other stocks out there that are going in the proper direction for you. So I think if I were going to give you just a jump start of how to get started in the markets, these would be a good set of ideas to help you think through how to go about investing in the market. And I think really you can have success, and part of that success is knowing that if you pay attention to the process you're doing, you pay attention to the at-risk portion of your money and how much downside risk you're going to allow, and just don't let those big losses get, or those losses get bigger and bigger because of the cost and improbable amount of investing opportunities you'll have to make that up. I think we talked about weeks before, if you let a stock drop 50% just to break even, it's got to get 100% gain, and you're probably not going to get a lot of 100% gains over time. So that means you need to cautiously watch the downside risk you're allowing to happen in a portfolio. So let's call it a day there. I thank you for your attention. I trust that you are going to have a great day today. I trust that you're going to remain curious and that you're going to begin to have success. As you make mistakes, count those as the University of Wall Street training, and just try not to repeat the same mistakes over and over again. I think that the more that you can get those mistakes out of your system, the better success in your batting average and your correct winning percentage will begin to go up. And so you'll begin to have more and more success. No guarantees. It's all about your trial and error. And feel free to call me anytime. And again, have a great day and remain curious.